Hello and welcome to our latest financial market commentary. I'm pleased to say that we remain positive about the outlook for both the global economy and indeed global financial markets. And the key change, which I've alluded to before, is this fundamental shift, a U-turn if you like, in the policy and the guidance emanating from the US Federal Reserve. And that is the most important factor for financial markets at the moment because it is influencing the cost of borrowing around the world. Now, just to go back in time to the end of last year, the US Federal Reserve was anticipating or signaling up to 3 interest rate increases in 2019, and their complete U-turn earlier this year is now giving guidance that increases will not occur in 2019. In fact, some market participants are expecting an interest rate cut, which I think is perhaps a little optimistic. Nevertheless, there is a big change underway, and that provides much more optimism for financial markets and has replaced the despondent mood that existed at the year end. So the robust recovery in financial markets that started in January has continued. I think markets probably will flatten off for the next few months because markets are concerned about the trade tensions between the US and China. But I would have thought that pragmatism will prevail because it's in the interests of both parties to come to a workable arrangement. Whatever you think of Donald Trump, he does have a point in relation to that unfairness in terms of the trading terms between the US and China. He does need to drive change, and however unpleasant his style, it is nevertheless effective because China has come to the table and the US is extracting concessions from them. Now, if we go back in time, of course, 20 years ago, it was US foreign policy to encourage China to industrialize in the hope that that would create more consumers for US businesses and also perhaps encourage democracy. So it's not a surprise that the terms are very much tilted at the moment in China's favor, and Trump is keen to change that quickly so that he can meet his own political commitments domestically. Trump needs to honor his commitment to his electorate. He wants to be re-elected. He wants a second term as president. And to get that, he needs to vigorously pursue his America First policy. And to be fair, it is working. It's great if you're American, not so good if you're not. And the UK, the EU, China, we're all on the receiving end of policies that are designed to enhance and improve the lot of American citizens and American voters. Trump's election in the US is just one of many signs around the world of a significant growth in populist politics. Many voters are dissatisfied with their lot, the lack of progress they've made in the aftermath of the global financial crisis, and they want change. And politicians, if they want to be elected, have to respond to that. Now, you might be wondering, what has all this got to do with financial markets and investment portfolios? Well, the answer is quite a lot. It's very important to anticipate global trends and try and compute what impact that's going to have on the value of financial assets. Now, the themes I've described so far in terms of monetary policy and populist politics, I think, are quite important. Look at the US Federal Reserve and their reluctance to increase interest rates because they're concerned about deflation. And I think that is indicative of the way central banks around the world are behaving. They don't want to see a low inflation environment. The world has far too much debt, and actually a little bit of inflation will be a good way to help get rid of that, because of course inflation reduces the real value of money that you might owe, and that counts whether you're an individual or indeed an indebted government. And in terms of populist politics, Trump being a good example, voters want to feel that they're getting a better deal, and that's going to come, I think, from more protectionism, which will slow down the rate of globalization, and also it will result, I think, in more fiscal stimulus from governments actually spending more money, a reversal of the austerity that we've got used to over the last decade. Now, all of these things are important because they all have an inflationary impact. So to summarize, the three main factors that we see driving inflation in the future are the likelihood that central banks will be behind the curve in terms of increase in interest rates as they want to see economies grow more quickly and will be more tolerant of inflation for the reasons I've described. Protectionism will mean that it will be more difficult to source products more cheaply around the world, and that will be inflationary. And then finally, governments will want to spend more money to keep their electorate happy, to stimulate the economy. That'll be inflationary too. So I think it's important to anticipate a general rise in inflation around the world. And if we look at the UK, and let's remember that most of our clients actually live in the UK, and therefore what is happening here is really important. The UK is broadly twice as susceptible to imported inflation as a result of currency fluctuation than, for example, the US or indeed the Eurozone. So if you look at the UK objectively from the perspective of those overseas, the uncertainty is encouraging investors to avoid the UK, both in terms of the UK stock market and indeed the pound, which is one of the reasons why the pound has been very weak. But of course, that isn't helpful for the UK economy because we import so much. We have a huge trade deficit with the rest of the world, and a weak pound will effectively import inflation. So that fourth factor is likely in the medium term, we think, to encourage much higher levels than we might otherwise expect in terms of inflation in the UK, which is a good reason to position portfolios, which is what we're doing, to ensure that asset classes that will benefit from a rising inflationary trend are central to portfolio strategy to ensure that our clients are protected and the spending power of their money is preserved. So to conclude, we believe that our clients can be confident that their portfolios are correctly structured and aligned to deal with both the current environment and developing trends, and also can be confident that over the medium to long term, the spending power of their capital can be preserved and indeed enhanced. Thank you so much for listening, and I look forward to talking to you next time.